There's a lot of confusion out there right now about interest rates, specifically mortgage rates, as it relates to the federal interest rate cuts that have happened recently. And the question that keeps coming up is, if the Fed is cutting rates, why are mortgage rates not falling? I'm going to break this down as best as I can so that you understand the difference between the federal interest rates and mortgage rates, how they are and are not related. First of all, when you hear that the Fed is cutting rates, what they're talking about is called the federal funds rate, okay? This is just a baseline interest rate that the Fed sets that kind of governs the exchange of money between banks more than anything. It is not, however, related to the mortgage interest rates that you will get when you get quoted a mortgage. Why not? Where do those come from? Those come from the bond market. The bond market is a debt facility. Basically, when you buy a treasury bond, you're lending the government your money for a fixed period of time at a fixed rate of return. And the bond that the mortgage rates follow is the 10-year bond. So you could buy today a 10-year treasury bond. You're going to get 4.13% interest on your money over that 10-year period, and they pay you every 6 months. And at the end of that 10-year period, you get paid back what you paid for the bond. Those prices go up and down with the market, supply and demand. And when those bond prices go up, the yields or the interest that you will make, that you will earn on that money, goes down. When the bond prices go down, the interest that you'll earn goes up. And when I say interest, I'm talking about the yield. So those two things, the prices and the yield, have an inverse relationship. That's important to understand if you want to understand how mortgage rates work. The more people that buy the bonds, the higher the price because of demand, and the lower the yield. The less people that buy the bond, the lower the price and the higher the yield. So when people are buying bonds, they're doing that because bonds are seen as safe. They're safe investments with a fixed rate of return. You won't lose your money. You might buy a bond if you really are not sure about what's going to happen with the economy in the near term. However, if there's strong economic signals and it looks like the economy is going to do great in the near term, you're probably not in bonds. And you probably are putting your money in other investments that may or may not be a little more risky, but you probably have a higher probability of earning a higher rate of return on that investment. So when the economy is strong, just think less people buy bonds. When the economy is weak, more people buy bonds. Let's lock and load that for a second. Go back to when the Fed cut interest rates by 0.5%. After they did that, most people expected mortgage rates to fall, which is completely logical. However, they went up. Why did they go up? Well, let's first talk about why the Fed cut in the first place. Usually, if you look back over history, the Fed cuts rates to try to stimulate the economy. They try to make the cost of borrowing money cheaper so that money flows more freely, which stimulates economic growth. Usually, the Fed does not cut if the economy is really strong. So the nature of their recent cuts goes in contradiction to the economic signals that sent the bond market or the bond yields up. Because after they cut rates, that same week, there was a jobs report that was published that said that the US economy added more jobs than expected. And that is a strong economic indicator. Now, let's set aside the fact that every time they've published a jobs report this year, they've gone back and revised that report lower. They've essentially said, we thought we created 300,000 jobs in the month of August, but we actually only created 200,000. I don't know why that happens, but it's happened consistently. So we'll see if that happens again. But let's set that aside for a moment, because it doesn't really matter in terms of where mortgage rates are at today. There were strong economic indicators that happened after the Fed cut rates. The bond market responded by a sell-off, basically, again, people getting out of bonds, going into other investment vehicles where they could get a higher rate of return, because again, that was a signal that the economy was going to remain strong. And when the economy is strong, people don't like bonds because they're conservative. And while they're safe, you just don't make a lot of money in relation to other opportunities that you might have to invest. So when there's a bond sell-off, people getting out of bonds, that causes yields to go up because it causes prices to go down. Follow? Less demand, prices go down, yields go up. Why does that happen? Well, kind of makes sense. If you have a lot of people buying the bonds, then they don't have to pay as much interest because they have demand there. They're getting their loans that they need. So they don't have to offer as much interest because the demand is steady. However, when there's a sell-off, when the people are getting out of the bonds, in order to attract new money into those bond products, they have to increase the interest rate, increase the amount of money that the new bondholders will make by buying those bonds. That's why they have that inverse relationship. Mortgage rates follow the 10-year treasury. So whatever the 10-year treasury yield is, mortgage rates are going to be 2 to 2.5 percentage points higher than that yield. So if the 10-year treasury right now is at 4.13, then mortgage rates should be at 6.13 to 6.63, and there's some fluctuation in there. That gap is called the spread. So lenders basically tack on another 2 to 2.5% so that they can hedge their risk and so they can make money, quite honestly. And the difference in you getting a lower or higher mortgage rate is really in that spread. Is it a smaller spread or is it a wider spread? That's where they look at your credit and things like that. But that they have to offer one person a lower rate and one person a higher rate, it's all in that spread. So that, though, setting the spread aside, the fluctuations in the spread aside, you've got that kind of spread tacked on to the 10-year treasury yield, and they move up and down together. Why did the yields go up when the Fed cut rates? Well, I already said, because of the labor report, because of the economic indicators that say that the economy is strong. And it's not common for the Fed to cut rates in a strong economy. So why did that happen? Well, they're basically trying to manufacture what they call a soft landing, where if they keep interest rates too high for too long, they risk kind of choking off the economy. And they don't want to do that. They had to raise rates when inflation went nuts because they had to bring inflation back under control. And while the inflation numbers aren't where they want it to be quite yet, it's trending in that direction. And the inflation always a lagging indicator. So whatever the Fed does today is going to show up in the inflation report like 6 months from now. So they're kind of playing this guessing game where the timing is everything, and they're trying to bring rates back down slowly and gradually so that they basically don't, like I said, choke the economy. And so that's why they're cutting early. And it's a really tough thing to do, this whole concept of a soft landing, but that's what they're trying to do. So they're lowering rates so that they can try to bring things under control in a gradual way, but there are still strong economic indicators out there that say that we have a really strong economy. I don't know about you, how you feel about that. I don't see it. I mean, I see that grocery prices are still high, gas is still high, the cost of everything is going up still. So, I don't know necessarily what to believe when it comes to like that the economy is really strong. But be that as it may, that's what we have. That's what we got. That's the information we've got to work with. And that's the information that the bond market follows. So this is really just about the inflows and outflows of money into different investment products and where the mortgage rates get their basis from, which is, again, that 10-year treasury. So I hope all that made sense. If you want more information about the federal funds rate, I did a longer video specifically about what that is last year, and I'll post it down below in the description. But if you're mortgage rate sensitive, if you're looking to buy a home in the next 6 to 12 months and you're really paying close attention to what rates are doing, don't worry so much about what the Fed does. Focus on the 10-year treasury yield and really the economic reports that come out, like the jobs report. And that'll give you a better indication of what mortgage rates are likely to do. So questions, comments, please post them below, and like and subscribe to this channel for more stuff like this. Thanks.